WP Carey, one of the larger REITs in the market, has reported good results in 2022. Despite a slightly challenging economic environment, the company managed to maintain a solid revenue growth with an increase of 11.2% compared to the previous year. Notably, WP Carey's net income showed significant improvement, surging by an impressive 46% year over year. However, despite these positive financial indicators, the stock price has experienced a decline of around 12.7% year to date. Today, we'll take a three-step approach to evaluate the company and determine their fair value. Step 1. Margin of safety. We'll assess WP Carey's key metrics and ratios to determine if we should be more or less cautious when determining a fair value. Here we'll delve into WP Carey's financial statements and assess critical metrics and ratios. In step 3, we use a combination of valuation methods such as funds from operations and discounted dividend to get an insight into the value of the business. This step allows us to understand whether the stock is overvalued or undervalued in the current market on different metrics. In conclusion, by combining the findings from the three steps, we'll ultimately determine the fair value of the company as an investment opportunity. To determine the final valuation of the company, we'll be using a margin of safety. This margin of safety will be based on the financial ratios, the financial health, and the growth of the company. I will be using a standard margin of safety of 25% that can never go below 0%. The margin of safety can either increase or decrease based on the ratios that we will look at in just a moment. And the severity that the margin of safety will increase or decrease by will be determined by using a scale. When we're using 4 colors in a scale, bright red will mean a 5% increase, orange will mean no change, light green will mean a 5% deduction, and bright green will mean a 10% deduction from a margin of safety. Where we're using 3 colors, bright red will mean a 5% increase, orange will mean no change, and bright green will mean a 5% deduction. The first metrics that we'll be using are the margin and EBIT growth. The EBIT has gone up over the years, going from $162 million in 2013 to $550 million. The EBIT growth during this period on average has been sitting at 16%, which looking at a scale gives them a 5% deduction on the margin of safety on this metric. The margin has also gone up over the years, going from 33% in 2013 to 37% in 2022. Average margin growth during this period was 4.1%, which is in the bright green part of our scale, indicating another 5% deduction from margin of safety. Next two metrics that we'll be looking at are the dividend growth and the debt to EBITDA. The dividends have gone up over the years, going from $2.40 a share in 2013 to $4.28 a share in 2023. The average dividend growth during this period is 6.4%, which is no change in the margin of safety on this metric. To get a debt to EBITDA, we have to take the debt of the company, subtract the cash from it, and divide it by the EBITDA. Out of this, we get the amount of years of EBITDA it takes for the company to pay off all of their debt. And for WP Carey, this is just under 5.5 years, in this case a 548% debt to EBITDA, which adds 5% to our margin of safety. And the final two ratios that we'll be looking at are the occupancy rate and the rent reversion. Occupancy rate is a key metric used in real estate analysis to measure the percentage of occupied rental units or properties within a specific portfolio. For WP Carey, 99% of their portfolio is currently occupied, which is a 5% reduction in margin of safety, seeing as a small part of their portfolio is currently vacant. The rent reversion rate refers to the potential for rental rates to change when leases are renewed or new tenants are acquired for property. This rate for WP Carey has been going up by only 1.1%, which is no change in the margin of safety on this metric. Let's go look at the valuation models next to determine the intrinsic value of the company. The first valuation model that we'll be using is the price to FFO mean reversion. The price to FFO, or funds from operations mean reversion, is a valuation model used to assess the attractiveness of a REIT stock price based on its historical FFO multiples. FFO is a key metric for REITs as it represents the cash flow generated from their core operations. In this model, we compare the current price to FFO ratio to its historical average. If the current ratio deviates significantly from the historical mean, it suggests that the stock may be undervalued or overvalued and is expected to revert to its mean over time. In this case, I've imported the price to FFO of 2018, 2022, and 2021. On average, in this period, it has been sitting at a price to FFO of $14.45, and the trailing 12 months P to FFO has been sitting at 12.62, indicating that it's currently slightly undervalued. And this gives us a fair value of this model of $76.45, which is almost a 14.5% upside from the current price. The second model that we'll be using is the dividend discount model. I've imported the dividend payouts of WP Carey going from 2018 to 2022. The average growth rate in their dividends during this period was almost sitting at 1%, and I'm projecting all of their future dividends to grow by the same 1%. and we'll use a discount rate in this valuation, giving them a dividend discount model price per share of $57.37, which is a 14.13% downside from the current price. The next model that we'll be using is the AFFO multiple valuation. Adjusted funds from operations, or AFFO, is a measure that reflects the REIT's FFO adjusted for capital expenditures and other non-recurring items necessary to maintain the property portfolio. AFFO is considered a more accurate representation of the cash available for distribution to shareholders. The AFFO multiple valuation is similar to price to FFO, but it uses the AFFO metric instead. By comparing the current market price to the AFFO, we can assess the relative value of the REIT compared to its peers. In this case, I've imported the P to AFFO of similar companies to WP Carey, and on average for these companies it's sitting at 12.64, while the P to AFFO for WP Carey is sitting at 12.81, indicating that it's slightly overvalued, giving it a price per share of this model of $65.88, which is only a 1.33% downside of this model. And the last model that we'll be using is the net asset value. Net asset value is a straightforward valuation model that estimates the value of a REIT based on its fair market value of its underlying assets minus liabilities. The value of a REIT's assets is typically determined by the appraisals of its real estate properties. Net asset value can provide a good indicator of a REIT's intrinsic value. Using this model, we've imported the net operating income for WP Carey and applied a growth rate estimate for the forward year. In this case, the net operating income has been sitting at $550 million, and we've applied a growth rate of 10%, giving them a forward year net operating income of $605 million. And then we have to determine the cap rate we use to determine the value of its assets. And we've gone with a cap rate of 2.5%, giving them a value of their assets of $24.2 billion. After that, we have to subtract the total debt, leaving them with a net asset value of $16.3 billion, and dividing this by the amount of shares outstanding, we get a net asset value price per share of $76.30, which is a 14.28% upside of this model. Let's go look at the final overview of our valuation next. Looking at our final overview, we've imported the price to FFO, discounted dividend, AFFO multiples, and the net asset value price per share, giving us an average of $69. Our margin of safety we've determined earlier using a standard margin of safety of 25%, deducting it by 5% for the EBIT growth, the margin growth, and the occupancy rate, and adding 5% for the debt to EBITDA, leaving us with a margin of safety of 15%. And applying this margin of safety, we get a fair value of $60.01, and with the current price of $66.81, we get a downside of 10.18%, indicating that through our valuation it is currently slightly a sell. If you want to get access to this model and many other models that I use in my videos, you can check in the description for my Patreon link. And if there's any other companies that you would like to see me cover on this channel, please let me know in the comments. And thanks for watching.